Okay, well, we're almost stopped by Bill Gates right there. So I'd like to thank the Chancellor, and thank you very much for that kind introduction. I've been given a very abrupt time schedule here, so what I want to start with is a picture, and hopefully this will substitute for 1,000 words. This is from a PhD thesis that was completed 2 years ago here by Kathy Fogel, who's now on tenure track at the University of Arkansas in the United States, and co-authored with myself and Bernard Young of NYU. What we did here is we looked at different countries, and we looked at how much their productivity grew over a set time period. This is the 1990s. And then we looked at the fraction of these companies, great corporations, from 1975 that had survived into the 1990s. And basically what we found was a very robust negative correlation. What that means is that countries whose economies grew the fastest and created the biggest increase in living standards had the highest death rate among their great corporations. Now that's kind of interesting. And so when we're talking about markets and failure, it seemed to me that maybe we should sort of step back and take a more metaphysical view of failure. Maybe failure isn't necessarily always a bad thing. What we think is going on there is due to the theories of this gentleman, Joseph Schumpeter, about whom I can talk at great length if you like. He's most famous for his quip at Harvard, where he was a professor in the mid-20th century, that when he was a young man in Vienna, he had 3 great wishes: to be the greatest lover of women in Vienna, to be the greatest horseman in Europe, and to be the greatest economist of his age, and that sadly he had only fulfilled 2 of his 3 childhood ambitions, and he would never tell anybody which 2. But what Schumpeter argued was that growth in a competitive economy, growth in a market economy, isn't really about the competition that economists spend their time talking about. Economists talk about how we have different companies that compete with each other to cut prices, to steal customers away from each other until profits are as bare as possible and consumers get the best deal that they possibly can get. Schumpeter said that's great, but that's not really what it's about. What it's about is competition to innovate. The firm that really wins is the firm that innovates first. That way the firm can steal customers away from other firms and raise its price. For instance, the way Kindle kind of is more expensive than other things, or an iPhone is more expensive than other things. You can actually steal customers and raise your price and increase your profits. And he said that's what creates economic growth and raises living standards. And continued prosperity, he says, arises because these new innovative firms like Research in Motion in Canada, or Microsoft or Google in the United States rise up and destroy old firms, like, say, Nortel in Canada. That's what economic growth is really about. And so it's a kind of economic selection that in some ways is like Charles Darwin's natural selection in the biological sciences. Creative firms have a competitive advantage. They destroy stagnant firms. And this famous quote by the chairman of the board of General Motors when he was being grilled by the Senate to become defense secretary in the 1950s, one of the senators said, "So you want to stay on as chairman of General Motors and you want to be defense secretary. Don't you think there might be a conflict of interest?" And he famously responded, "What's good for the country is good for General Motors and vice versa." It's just not true. Now, Schumpeter says, into the middle of this, we have to have capital markets. We have to have the financial system. We, or our mutual funds, or our pension funds, buy the stocks and debts of businesses that make profits and pay returns. And so what we have is we have our widows and orphans, the capitalists, the people with savings, depositing money into their banks that lend money to businesses, buying stocks, buying bonds that fund businesses, and those businesses produce products and generate returns and pay interest or dividends or capital gains back to investors, and the financial system goes round and round and round, and that's how it works. Schumpeter said, the problem is that creative entrepreneurs often, not always, but often do not have billionaire parents. I don't know if you've noticed that, but sometimes the most creative people don't have the richest parents. And Schumpeter said, what you need the financial system for is to fix that. The financial system, the purpose, the social purpose of the financial system is to connect people with money and people with ideas. So, example, this is Thomas Edison, who invented the light bulb and a whole bunch of other wonderful things. He needed money. He was poor, didn't have rich parents. And this is J.P. Morgan. J.P. Morgan discovered Edison and said, this guy is brilliant. And so J.P. Morgan went back and forth across the Atlantic, selling shares to rich Europeans, carrying the money back to Edison. Edison built more factories, bought more little companies, built up General Electric into a huge corporation that paid dividends back to the Europeans, and that's the way the system works. And Edison, because he was a brilliant entrepreneur, didn't have to lower his prices. He didn't have to make his electric light bulbs cheap to make people switch away from kerosene lamps. They pay high prices for electric light because it was better. And so he actually paid very high returns, much higher than everybody else was paying. And that led to a flood of capital into Edison and into all sorts of other electric companies in the 1920s, the 1900s, and the 1920s. And the result was a huge capitalization of a new industry. And old companies that make kerosene lamps fell away. But in economics, selection is a little bit different than it is in the biological sciences, because in economics, this guy, I don't know if you remember Jean-Baptiste Lamarck from your high school biology. He was the guy that they made fun of in high school biology because he thought that giraffes evolved by stretching their necks to reach fruit or leaves in the high trees, and each generation of giraffes stretched their necks a little bit more, and ultimately they all had long necks. That doesn't work in biology, but it does work in economics, because what happens is imitators arise. Other companies arise that start to make electric light bulbs or other electric apparatuses that compete with Edison, and ultimately General Electric's profits started to fall and fall and fall because they had to cut their prices because other people were also making this wonderful new type of product. And so what happened was one day, instead of this, you get this. General Electric starts to look like any other company. It doesn't look wonderful and entrepreneurial and high return anymore, and the investors suddenly notice that this has happened. The returns start to look normal too. And when that happens, we get a stock market crash. This is the crash of 1929, and this is probably the worst we've ever done. It heralded the Great Depression. People talk about the current crash heralding the Great Recession. That's a little bit of newspaper hyperbole. I know the Chancellor is a newspaper person, and I don't want to go down on the media, but this is what our current stock market bubble and crash looks like in percentage terms compared to the bubble of the 1920s and the crash of the 1920s. We're just not in the same league. So how do we explain this? I think the best explanation of this comes from financial history, and I really encourage you to go out and buy this book. It's a wonderful book by Charles Kindleberger called Manias, Panics, and Crashes. And Kindleberger looks at stock market bubbles and crashes for the past 400 years. We've basically had them ever since we started capitalism. The first one that's well recorded was the Tulip bubble of the Netherlands. The Dutch discovered tulips, and tulips were a craze. Everybody wanted tulips, and so you could buy tulip bulbs one day and sell them the next week for a 50% profit. And so everybody started buying tulip bulbs. And tulip prices went up and up and up and up and up, and people were selling their homes to buy tulip bulbs. And merchants were selling their seagoing ships to buy tulip bulbs. And it went up and up and up, and then it collapsed, and everybody lost everything. Another really cool bubble was in 1720. There was an IPO boom. The South Seas Company was the biggest participant in this, but lots of other companies were involved too. People had gotten very rich off the British East India Company and the Hudson's Bay Company, and everybody wanted in on the next big thing. And so a bunch of entrepreneurs stepped forward to offer the next big thing. And of course, these were all fraudulent companies. They were all completely crazy with no real business plans, but people scrambled. There were fist fights. There were sword fights because there weren't enough shares in these companies to go around. The prices went up and up and up and up. And Isaac Newton, then a grand old man, had been appointed Master of the Royal Mint, basically finance minister. And he apparently worried about this and advised people not to put their money in, and then ultimately decided he was wrong, put his life savings into these companies, and was wiped out. Kind of discovered gravity like again.